US markets bid in expectations for a soft landing ahead of key inflation data. China's core inflation is the lowest in 3 years, prompting calls for more stimulus, and Taiwan's exports get an AI boost. That's coming up in our 5 Things in 5 minutes. And then in our bonus deep dive interview, from last week's ANZ-sponsored AFR Asia Summit, Australia's Group of 8 University CEO Vicky Thompson talked to me about the challenges facing Australia's international education sector.
Last year, half of Australia's economic growth was on the back of international student spend. So if you start to play around at the edges with that, the impact is not just about what's happening in our universities.
But first, in 5 and 5 with ANZ. US stocks rose overnight as comfort increased that a soft economic landing is underway for the world's largest economy. At 4 a.m. Sydney-Melbourne time, the S&P 500 was up 1.2%, while yields on US Treasuries were pretty much flat, as traders wait on tomorrow's US inflation data for clues on what the Fed will do to rates when it meets next week. ANZ economist Bansi Madhavani says the market is currently pricing a 30% chance of a 50 basis point cut.
The debate is still going on whether the Fed needs to front-load rate cuts, which is by cutting 50 basis points, or it needs to move in a gradual manner, which is by cutting 25 basis points. Our take is that the Fed does not need to rush into a 50 basis points cut. A central view is that a soft landing is on track, growth and activity are broadly holding up, labour market has softened, and the rates will need to be cut to arrest any further weakness.
The US dollar index was up 0.3% at 4 a.m. Sydney-Melbourne time, the Aussie dollar down 0.05% at 66.66 US cents, while the Kiwi was down 0.3% at 61.53 US cents. Number 2, supporting that soft landing view, ANZ senior economist Tom Kenny says last week's US labour market data, which was weaker in some areas, did contain some positive points.
We saw an increase in hours worked in August. We saw average hourly earnings increasing. We also saw quits rates and hiring rates increasing in the month of July. So overall, there was nothing in this data really to suggest to us that there was an untoward weakening in the labour market. Moreover, following the non-farm payrolls data out on Friday night, there were a couple of Fed speakers post this data. None of the speakers there seemed to express undue concern at the labour market data.
Number 3, China's inflation in the year to August was below expectations at 0.6%, while core inflation at 0.3% was the lowest in 3 years. This again prompted calls for more stimulus to hit the 5% GDP growth target. ANZ senior China strategist Xiaopeng Zheng says action is needed on both the demand and supply sides of the economy.
For the demand side policy, I expect the PBOC are ready to cut both RRR and policy rate. On the supply side, I think the policymaker will not move very quickly. It will need time for the policymaker to negotiate with the industries so that they can cut the capacity in the economy.
Number 4. Today in Australia, NAB's business survey will show if the Stage 3 tax cuts and other cost of living measures are supporting business confidence. ANZ economist Maddie Dunk says cost and price growth indicators are also important to watch.
What we've seen is that the cost and price growth indicators in the NAB business survey are consistent with inflation being back within target. Now, in the last data release, what we saw was that the labour cost measure ticked up, and that's reflecting those minimum and award wages. We generally see the labour cost measure move upwards in July. So when we're looking at August data, it will be interesting to see whether there's much reversion there. We should expect to see a move down in that measure and broadly see that those price and cost growth measures continue to moderate.
Number 5, robust demand for semiconductors and other AI-linked tech drove Taiwan's exports up 16.8% from a year ago in August. Bansi Madhavani says the outlook remains positive because of 3 factors.
1, an easing in global monetary policy cycle. 2, a structural uptrend in demand for high-end semiconductors. And 3, Taiwan's own position on tech value chain as one of the leading-edge manufacturers.
Bansi Madhavani there. Now, for our bonus deep dive interview, I spoke at last week's ANZ-sponsored AFR Asia Summit to the Group of 8 University CEO in Australia, Vicky Thompson, about how recent policy changes are affecting not only Australia's international education sector, but tourism and the broader economy as well. To such an extent, it actually caught the RBA's attention.
Our universities across Australia are worth $48 billion in terms of our export services. So we're Australia's fourth largest export sector, largest services export sector. Our reach is deep and broad into the Asia region. A lot of focus is always on our reach into China, of course, and we are engaged in China both in education and research, but particularly deep partnerships in Indonesia, Malaysia, Singapore, and of course China, Japan. And it makes sense, right? Because, these are the countries that are just in our region. So, of course, for decades, we've been educating students from the region. And, of course, we've had deep research partnerships. So it's a huge export sector. It's also a really huge contributor to our tourism sector. 69% of Australia's tourism spend last year was on the back of international education. That's a statistic that people are often surprised at because kids come and their mum and dad come and then they come again and they go out and visit the great places to see in Australia. And I think the other really important thing to note is that, last year, half of Australia's economic growth was on the back of international student spend. Half of our GDP growth. I mean, it's worth repeating because it's quite phenomenal.
So tell us what's happened in the sector in the last couple of years. There's been a few swings and roundabouts. What's happened with enrolments?
Pre-COVID, we were chugging along as a sector. In terms of our economic output, it was really strong. COVID hit, obviously. Every part of the economy was impacted. Interestingly, for the group of 8 universities, we held our numbers, even though students couldn't come here. So that is a testament to the quality offering that we've got. And so when we came out of COVID, 2022 was a little sort of tenuous and we were growing. 2023 was our rebuild. And then 2024 has just, that pent-up demand has really come in. What we're seeing now, and we're talking to you, in September, we've just got visa data through for July. We've had a 43% drop in visa applications from the previous month. And that's a 35% drop from July last year. So signalling is going out into the market on 2 things. One, the Australian government's increased their visa application fees. So at $1,600, we're now the highest in the Western world, higher than Canada, higher than New Zealand, higher than the US, non-refundable. And the second thing, of course, is the Australian government has now signalled its intent to cap the university international or the entire international education sector. But the big lever is, of course, the university sector. And so students and prospective students are seeing those 2 things and they're voting with their feet and thinking, well, we'll go elsewhere. That will have an incredibly damaging knock-on effect to our economy for the reasons that I've just articulated in terms of the numbers and the impact that our students have on our broader economy.
And it's even been mentioned by the Reserve Bank of Australia, I hear, in commentary on the economic outlook.
We've had commentary from the RBA in the last few weeks as we prepare for economic figures, and we know there's going to be a softening in the broader economy. But their comments are around the fact that if we continue to see a decline in international students, we therefore continue to see a decline in spend because students come and spend, they rent, they spend money in pubs and clubs and cafes, they work. So that's also the double whammy of decreased expenditure and impact on the labour market. They've really signalled, I think, the canary in the coal mine that our growth will continue to slow. So this is a much broader impact than just on our universities, but I don't want to dismiss the impact on our universities because for our universities, the group of 8, we estimate it'll be about $1 billion in reduced revenue in 2025. So when you have $1 billion less coming in, you have to start making some pretty tough decisions around your research, your teaching, your staffing, etc.
Vicky Thompson there, the CEO of Australia's Group of 8 universities. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, September the 10th. Catch you tomorrow with a preview of US inflation data and a review of today's Australian business confidence figures. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.